The oil crisis that could change everything. Gas prices don't need a slow economic buildup to spike dramatically. In certain supply shock scenarios, they can move rapidly towards $6 or even $7 per gallon in the United States. Not because of gradual inflation trends, but because global oil supply depends on a small number of extremely concentrated shipping routes. One of the most important is the Strait of Hormuz. This narrow waterway connects the Persian Gulf, home to major oil producers, to global markets. Roughly 17 to 20 million barrels of oil pass through it every day, about 1/5 of global consumption. Global spare production capacity is only a few million barrels per day, concentrated in a handful of countries. That leaves limited backup in a disruption. At its narrowest point, the strait is about 21 miles wide, with shipping lanes even narrower. That creates a structural bottleneck in global energy flow. Countries like Saudi Arabia, Iraq, Kuwait, and the UAE rely heavily on it for exports. Alternative pipelines exist, but they handle only a fraction of total flow. So the global oil system depends on uninterrupted passage through this corridor. Oil markets are forward-looking. Prices adjust to perceived supply risk even before any physical disruption occurs. In tight conditions, those moves accelerate because there is limited slack in the system. Oil is not just gasoline. It is a core input in global production. It powers transport, manufacturing, agriculture, aviation, and chemicals. So price changes don't stay in fuel markets. They spread through the entire economy. Transportation is the first impact. Diesel and jet fuel track crude oil closely, so shipping, trucking, and airlines adjust almost immediately. Jet fuel can represent roughly 20 to 30% of airline operating costs, making airlines highly sensitive to price spikes. From there, supply chains transmit the shock. Shipping goods becomes more expensive. Retailers raise prices to protect margins. Food costs rise due to transport and agricultural input costs. Energy shocks move in layers. Energy transportation, goods, household budgets. This is why oil spikes are among the fastest drivers of inflation. Energy is only about 5 to 10% of CPI directly, but its indirect impact is much larger because it affects nearly every stage of production. When inflation rises, central banks respond. They often keep interest rates higher for longer, even when the shock is supply-driven. That raises borrowing costs across the economy. Mortgages become more expensive. Credit card debt increases. Business investment slows. Financial markets reprice downward as discount rates rise. Historically, major oil shocks, 1973, 1979, and 2008, have coincided with or preceded economic slowdowns. Not because oil alone causes recessions, but because it reduces disposable income and consumer spending. More money spent on energy means less spent elsewhere. The key issue is geography. The Strait of Hormuz has no true replacement at its scale. Pipelines in the region cannot match maritime capacity. That creates a structural bottleneck in global energy flow. Markets react to risk, not outcomes. If traders believe supply may be disrupted, prices adjust immediately, even before any physical change occurs. When inventories are tight, those moves accelerate because there is limited slack in the system. At a global scale, the world consumes over 100 million barrels of oil per day. Even small percentage disruptions represent millions of barrels of imbalance. In stressed markets, price moves become amplified due to limited substitution options. To track risk, for indicators matter. Oil price momentum, shipping and insurance costs in key routes, inflation data, central bank policy signals. And in a system this interconnected, shocks propagate across markets, industries, and households. That is why the Strait of Hormuz remains one of the most important pressure points in the global economy. A narrow passage with outsized influence on inflation, trade, and financial stability. The real question isn't whether prices rise. It's how long disruption lasts and how far the effects spread once it begins. Because in global energy markets, small shifts can create large economic consequences. Do you think global oil markets stabilize from here, or are structural risks increasing? Let me know in the comments.